Gary, you say you prefer bonds over stocks. If you're looking for yield, where do you go when treasuries, 10-year treasuries are sub 1?
Yeah, no, it's a real tough time. But I think at this point in time, you want asset classes that are supported by the policymakers very directly, which is what government bonds are. I'm not so sure you go chasing yield for the moment. There's certainly some opportunities that appear to be coming in. We've seen a very huge spike in high yield spreads and indeed investment grade spreads. But we're probably only 2/3 the way through that correction, and therefore you need to bide your time. But bonds preferred to equities.
You know, it's a zero-rate world. I mean, how do you trade assets in such an environment?
It's extremely difficult. I mean, if I go back to my experiences, even back in 1987, you could almost day trade things. But the violent corrections we're seeing in asset prices, 1 minute we could be up 5, next minute down 10. It means that day traders are finding it very difficult to get in and out with a profit. That huge volatility, I think, will keep those volumes away from the market. And that's why we're not really finding a floor to markets at present.
Right. I mean, there's a lot of people that question amidst this panic. It's just really hard it's an uninvestable market, it seems, right now, Gary. So, I mean, what are you telling your clients right now? Is this something that you just have to hunker down and wait until the infection curve goes down? I mean, what signs do you have to see first for us to start seeing at least some type of bottoming out process?
Yeah, it's very difficult. I think because this is so unique. I mean, quite frankly, you have to go back to the Spanish flu to find something that hit the global economy with this kind of problem. And the problem is not solved by policymakers. The problem is only mitigated by the policymakers. So we're seeing some good support. We're seeing every government and every central bank actively engaged. But at the end of the day, we have to wait for this virus to disappear. The social distancing we have is having a dramatic impact on global GDP. And even if certain countries get on top of it for a few weeks or a few months, they will be mindful that if someone comes into the country, they create the problem again. So I think we've got an extended period here of really trouble in the global economy and policymakers really only just trying to help.
What would you be investing in, though, once we declog these market dislocations, the funding stresses we've seen start to calm down, and markets actually start to trade purely on fundamentals again?
Yeah, to be fair, I mean, I think like lots of asset management business at the moment, we're putting together lists of things that we want to buy. Companies that have clearly got strong balance sheets, companies that have a very clear, very strong brand in their space. In consumer staples and some of even luxury goods, clearly 2 years from now, people will be back out buying handbags or something. But, companies with strong brands, strong balance sheets, things that are going to still be in existence 18 months from now. I know it's very difficult to see that far ahead, but many of these companies have seen a halving of their share prices. They offer long-term fundamental value. It's just that I can't promise that this is the bottom.
Yvonne and I will be buying handbags, we can tell you that. Now, the thing is, everything is getting sold off. Even gold is getting sold off for cash. If you take a look at your portfolio, how much cash should you be holding? Because some say it goes from 50%, some as high as 90%.
Yes, I know. We're seeing some extremes. It really depends upon your personal circumstances. If you think your job's at risk, that you'd have to move country, that, there's something very major that you would have to spend money on, it's better to be out of the markets and in cash, and therefore you've got the resources to support that potential outcome. Otherwise, I wouldn't disagree with people who say you need 20 or 30% cash at this point, because even the safest of bonds at times have seen huge volatility, and in equity markets, we're hearing forecasts of a further 20 or 30% downside before this major correction is complete, and therefore people really won't want to wear that emotionally.
Gary, I want to get your thoughts on the question of the day, which is, what would be the impact on assets of 30% U.S. jobless?
A good question. I think at this point, we're probably only discounting something like 6 or 7%. I think people will be extremely worried. Now, 30% is realistic. There are far too many people these days in the United States on short-term contracts or freelancers. Very different to where we were 10 years ago. So that is a possibility. My own best guess, it's probably going to be closer to 20%. And let's hope that it's just a short-term phenomenon rather than something that persists for some time.